What's going on? Good to be live with y'all today. I hope everyone is doing wonderful. So as I mentioned, yesterday that we would be hosting a little conversation about the investment climate. There's a lot going on. We're getting a lot of questions from friends, from clients about what they should be doing. Do they need to be concerned? And what should we expect? And so today I wanted to spend a little bit of time with you guys just to let you know the things that we're looking at. So we'll be discussing how is the market currently valued, and what does that mean for your investment portfolio and the returns that you can be expecting on your investments. We'll also talk about if there is a big market correction, how do you manage through that? What are some of the tools and tips and techniques that you can take to manage through that? And then we'll talk a few risk management measures that you might want to consider when it comes to your overall investment portfolio and the way that you manage your overall financial life. So as we breeze through here, hopefully you can see everything on my screen, but I'm happy to chat with any of you guys after about questions that you may have. And as a disclaimer, I'm not giving you specific investment advice. You need to consult with your own plan, your own advisor, and making sure that whatever I say here works for your best interest. I just want you to know the things that we're talking about and the things that you need to be aware of as you continue to move through your investment plan going forward. So a big thing that we're going to get into is what do valuations say about expected asset class returns? We'll talk briefly about stocks, about bonds, about real estate, about commodities, and ultimately, what does the trend say about these different asset classes and how that might impact you and your finances going forward. So the first thing that I want to really talk about is valuations. And this first little screen, it's showing Warren Buffett's favorite market valuation measure. It's called Tobins Q Ratio. And Tobins Q Ratio basically looks at the net worth of the total investable universe, the net worth of all companies, compared to the market capitalization of all companies, what they're valued at in the marketplace, what people are paying in terms of stock prices versus what their underlying replacement cost to rebuild all those assets are. And it's interesting how you can see on the chart that the current valuation is 1.14. Now this is significantly higher than its historical average and not quite as high as what it was during the tech bubble when prices got crazy high, but very much at the top end of its range historically, dating back to 1900. You can see it's bumping up along the top edges. So from Warren Buffett's favorite measure, it's very, very highly valued market. And the higher the price that you're paying for something, the lower the likely return that you're going to get going forward. So that's one thing that you need to be aware of. Excuse me, just turn that off. The other thing that people and advisors refer to lately is another valuation measure called the CAPE, or it's the cyclically adjusted price to earnings ratio. Now, this basically tells you what the multiple of earnings are that you're paying when you buy into the US stock market. And so why is it cyclically adjusted versus the earnings over the past year? Is because it smooths out economic cycles. So it's a longer term earnings measure. And what you can see here is that the current CAPE ratio is 31. This is one of the highest prices in history. Black Tuesday, that was essentially during the Great Depression. We have Black Monday, which is the stock market crash of '87. Then we can see what happened back in 2000 during the tech bubble. But the current CAPE ratio, the price to earnings ratio over the long term, is 31. Now you might be saying, Matt, what the heck does that actually mean? Well, I guess for one thing, you can see that it's showing that the market's pretty high. There was a lot lower CAPE ratios back in the 80s. There was the CAPE ratio was pretty low back in 2009 when everyone was selling their stocks. That's when the CAPE hit a very low measure, which provided a good opportunity. So you want to be buying low and selling high valuations, buying low valuations. Now, the reason why the CAPE is somewhat important to understand is because we're not just saying it's a highly valued market. Let's sell immediately, but you do need to understand that the CAPE ratio has a very strong correlation between the future returns of your investment portfolio. So this doesn't just hold for US stocks, it holds for all stocks, international, European, emerging markets. And so you can see the correlation between the CAPE ratio and the underlying returns over the next 10 to 15 years of your portfolio. It's not going to tell you what's going to happen today or tomorrow or the next week or the next month. But basically, if you're paying a high price to earnings based on the CAPE today, your expected returns are going to be significantly lower, and there's a high correlation between the two. The higher the price, the lower returns on your portfolio that you're going to get over the next 10 to 15 years. Now that doesn't mean that the market has to crash today or tomorrow, or that the market even has to go down significantly. What it might mean is that there might not be much appreciation over the next decade, and you might have a flat market. So it doesn't tell us anything about that, but it does tell us that if you're paying a high CAPE multiple, you should be expecting very low returns on your investment portfolio in that asset class going forward. Now, this chart might be hard to see, but this is showing expected returns from different asset classes, and I'll kind of briefly touch on those. This shows the real returns, the after-tax inflation returns, as it takes into account those valuations. And so what you can see here is that emerging market stocks, they have the highest expected returns going forward over the next 10 years. EAFE, that shows international markets having a higher expected return, whereas US stocks, large and small, our expected returns are about 2 to 2.5% per year over the next decade. This is a lot lower than it has been explained to you from historical context purposes. It's averaged 8, 9, 10% per year over the prior 50 years plus. Now US stocks are projected to return about 2 to 2.5%. Emerging markets and international stocks, a lot higher of expected returns. So if you're looking at your investment portfolio and you're trying to figure out what is the return I need to reach my goals, what asset classes are going to help me get there, you're likely going to be left, if you're fully in US stocks like most financial advisors' portfolios are, or most US investors' portfolio, you're likely going to be looking at a lot lower returns than if you add some international diversification to your portfolio. So it's a very important concept that you understand the valuation that you're paying and the expected return that you're going to get over the next decade. So really important. I'm happy to share this slide if it's hard for you to see it. So based on the CAPE itself, here is some projected returns in a little bit more detail. US stocks, 2.9% per year over the next 10 years. Developed European markets, 6.4%, and emerging markets, 6.8%. So if you're thinking about it, the higher long-term expected returns are found outside the United States. Now don't ignore that. Just because the CAPE is high, it was high a year ago, a high 6 months ago. This valuation measure works over long periods of time. It tells us what it's likely going to be realized over the next 6, 7, 10 to 15 years in terms of returns, not today and tomorrow. So a lot higher returns outside the US. And here's some gurus I think it's important for you to be aware of. What are some of the smartest people out there talking about for returns? Ray Dalio, Bridgewater Associates, the largest hedge fund in the world. He's saying US stocks are going to generate 2.7% per year annual return. Emerging markets, 7.4% annual return. Somebody that we should be listening to. Vanguard, they expect US stocks to generate 3 to 5% per year over the next decade, and global stocks, including international and emerging markets, 4.5 to 6.5%. Research affiliates, they're expecting US stocks to return about 2% per year over the next decade. Emerging markets, closer to 7%. And GMO, which is another institutional asset class manager, they expect large cap US stocks to generate an after inflation return of negative 4% per year, and emerging markets to generate a 2% real return. So they're a little bit more less optimistic than the rest, even though the rest are pretty conservative too in their estimate of actual returns. These are much lower than returns experienced over the last decade and historically, but that's because of the valuations that the market is currently placed on the market caps of these companies. So really something to be aware of. Now as far as bond yields, a lot of people have portfolios comprised of stocks, comprised of bonds. If we're only getting 2% from stocks, what might we be getting from our bonds? Well, what you can expect from your bonds is basically the yield that you're paying. And yields are low across the globe. You can see that the global aggregate bond fund yield is expected in the 3% range. So if you're buying just the bond index across the globe, 3% is the return that you can expect from that portfolio. So now think about it. If you keep half of your money in US stocks, that gives you 2%. Half your money in global bonds, that gives you 3%, you can be expecting a 3.5%, 2.5% return on your portfolio. This is pretty low. So you need to think about what are the best ways to position yourself going forward to realize better appreciation in that in a smart way that doesn't increase the risk that you're taking commensurately. So expected returns in real estate, we're not saying what the returns are specifically, but you can see that cap rates, what the cap rates are. And the cap rate is kind of like the inverse of the PE ratio we're talking about. It's basically the yield that you're getting on the valuation of the portfolio. Class A apartments, 4.5% cap rate. If you invest $100,000, you're going to generate a yield of about 4.5% on your investment, not including leverage. So other asset classes, 5% cap rates. So these cap rates are lower than they were historically speaking as well. So if there's price depreciation, that's not what we're saying. If cap rates, go higher and revert back to the mean, you might be expecting lower returns on your real estate portfolio than what's been experienced over the last decade. Now, real estate is not like the stock market. There's a lot more differences in geography. It's not nearly as efficient. Not as many people can buy a $50 million building, but it's pretty easy to buy a $50 stock. Pretty much anybody can do that. The access to these investments are not as great. So it's more illiquid, it's more inefficient, which allows for opportunities from the right investors to find them. But as a whole, real estate might be a good asset class, but as a whole, it's not as good of a valuation as it can be seen from a historical standpoint. Now, if we think if cap rates are low, we've got a reserve for maintenance and to maintain the quality of the portfolio and reinvest about 2% back, we might be generating real returns after inflation returns of our real estate of 2.5%. So if we add inflation of 2.5% on there, we might be looking at a 4.5%, 5% return broadly from a real estate portfolio. So that's always something to think about. And a lot of our real estate investor clients, the way that they live their life and have eternal financial freedom is that they live only off the yield, only off the cash flow produced from their portfolio. So if their portfolios are fully paid off and it's generating a 4.5% yield, they're living off that 4.5% cash flow and nothing else. So that's how they manage their life. Appreciation happens over the long term, debt pay down happens over the long term, but it's not lived off of, so to speak. So real estate returns positive, just not as great as they were historically, and not crazy high returns on average to be expected unless you partner with the right people. Now, commodities versus stocks. Commodities are a unique asset class. They're very much more speculative in nature. They don't have an intrinsic value other than the price that somebody's willing to pay for it. They don't generate yield or generate specific cash flow like real estate or a stock or a bond does. That said, commodities versus stocks. How much commodities can we buy to get the S&P 500? Now, the commodity valuation is pretty much the lowest it has ever been historically versus stocks. So if we had to take $100 worth of commodities, how much of the S&P 500 or the stock market could we buy? And basically, we could buy essentially one. It's gotten as high as 8, 9, 7, 6, so it's very, very low. So of all the asset classes in the world, commodities is one of the cheapest out there. People have not liked oil for some time. Agricultural commodities have struggled. So all of these different asset classes across the globe in the commodity basket have had a difficult go over the last number of years, presenting investors with a potential opportunity in an asset class that does well during times of high inflation, high interest rates, and many times economic contraction. So commodities are an interesting asset class to look at because of the fact that they are so low, the valuation is so low relative to stocks. So something to think about as you look at your portfolio. Now, long term, simply adding them as a basket of your portfolio forever, do they add a lot of value? Not a ton, but for periods of time, they can certainly help protect and provide an opportunity inside of someone's portfolio. So the other thing to look at is just the trend and momentum. We might know that the stock market is highly valued, and I could argue that it was highly valued when the CAPE ratio was 24, 25, 26, 27, 28, 29, 30. Where was it valued like that? It was valued like that here, and here, and here, and here, and here, and here. It's been high, the CAPE has been high for many, 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 many years, but we need to also understand that when does the market break down? What does the trend say? And the trend, this is from 2009, the market bottom, remains up. We've seen some big volatility over the past few weeks, over the past few months since January of this year, but the market price remains above its long-term trend line. And you can see, where do all the accidents in the market happen? Where does all the quick declines actually show up? Well, when the trend rolls over and when price gets below it. Look at what happened in 2007 and 2008. Once the trend rolled over, all the Great Recession pretty much happened below that trend line. 2000, same thing, way below the trend line. Had a period of that back in 2015-16, but it recovered. Now here we're getting towards the top end of a cycle. The psychology of the market's changing. The character of the market's changing, and you can see that. Very smooth volatility. Now volatility is starting to pick up, and that could signify a change in trend. It just hasn't fully changed its trend yet. And we don't want to anticipate. We don't want to just say because the market's overvalued here, we shouldn't get out. Look at all the opportunity there's been as an investor over the past number of years, even with a highly valued market. You can't solely rely on valuation to make all of your investment decisions, but it's a very good starting point. So here's a little interesting figure. This basically shows that chart that we were looking at. If you were to simply buy and hold the stock market, or buy and hold or sell when the market gets below its long-term trend line. And it's interesting, and then buy when it gets back above it. So what this is showing, it's really helping us follow what the money is doing. What are people thinking about? What's the human psychology? What are investors actually doing? If you were to sell every time the market broke below that trend line that we showed you, and then buy every time it went above it, your performance would significantly exceed that of just buying the market. Now, the reason why it works is that it allows you to get out of the market during very difficult periods of time, but also get in after the market has started to recover, and you eliminate some of the declines. The reason why this works is because it takes a lot of patience, and most investors have very little patience. There's a lot of market data and science and academic evidence that tells us that this works, but there's going to be plenty of years where there's underperformance in this model. It will underperform during bull markets, and it is outperformed during bear markets, but people don't want to go 5-10 years with having some of their portfolio underperform, so they don't stick with it. They don't remain disciplined. They don't remain committed, and that's why they don't realize the returns of certain strategies as it relates to managing their portfolio. So something to be aware of. The trend it might be shifting now, and it makes sense to pay attention. And then that's where the high valuation arguments might really be heard on the headlines and in the media. So what can we do now knowing that volatility has picked up? How can we manage through a market correction? What do we need to be thinking about? Well, you need to know market history. And most of you haven't done enough homework on market history to know what to expect. For some people, it might be just continuing to buy throughout these corrections to take advantage of lower prices. We also need to have adequate liquidity. We might want to consider owning commodities, and we need to have a plan and stick with it. So this is what I want to show people. This looks at the market declines, historically speaking, since 1900. You as an investor need to be prepared for many market declines throughout your investment lifetime. A 5% decline happens multiple times a year on average. A 10% or more decline in the stock market happens about once a year on average. A 15% decline happens every 2 years, and a 20% or more decline, which people would call a bear market, happens about every 3.5 years. Well, we haven't seen that since 2009. So I think we're getting later in this market cycle. Same thing for the 10% decline. Haven't had one since about 2015, 2016. So we're now 2 years removed from something that happens about once a year. So you guys need to be prepared that this is part of being an investor. It is completely normal. It happens in stocks, it happens in real estate, corrections happen, but the stock market is more volatile, and you see the headlines and you see the value of your accounts fluctuating. So you just need to know that this is going to be normal, and you need to be prepared for it. Do not panic, do not get overly concerned. That's how you hurt your investment and cause yourself to not build wealth. So know history. It'll help you deal with these times when they show up. Because what we're seeing now, the recent correction that we've received, it is normal contextually. It doesn't feel normal, but it's completely normal. So you got to take a breath and understand history. So here's some other price declines. How many there were? What's the average drop from the peak? How long does it take to recover? In another scenario, these mega bear markets, it takes about 3 years to recover, 58 months to recover from its decline. Little over 4 years. For a traditional bear market, regular like 20-25% bear market, takes about 2 years to recover. You need to be able to live through these corrections and not panic and sell. They have always recovered. They always recover, but investors' portfolios don't because they panic and sell because they're not prepared. Be prepared, do your homework, do not panic. Look at this market history. I think what it shows you, this is from basically 1930 and onwards. There's been some pretty bad things that have happened in your lifetime. There's been the Great Recession, the Great Depression, there's been wars, there's been terrorism, there's been many, many bad things. But every single down that there's been in the stock market, it's only been temporary. The ups have been permanent. They've always lasted. You don't see the results in investors because they haven't been disciplined to achieve them. That is why you need to know history and have a plan and understand how to behave properly through these corrections because they allow you to generate wealth over the long term. Other techniques that people employ, especially non-retirees, is that they just keep buying. They've got a system and they know that because they see this chart, I'm going to keep buying. I'm going to keep putting into the market and taking advantage of opportunities. This first chart basically shows if I buy a stock or if I buy the market and I buy it at $100 a share and put $5,000 in, if it drops 25% and I sell, I'm only have $37.50. But if I continue to buy and put money into the portfolio in small increments throughout time, even as the stock price declines, my portfolio value will recover exponentially over time. And that's why you want to be taking advantage, if you have a portfolio, knowing when to buy, how to make that decision systematic and not emotions based. When do we buy? At what interval of decline do we buy more? What am I buying? What asset class do I buy? How do I continue to work my way into the market during these declines and use it as an opportunity versus using it as a place to panic and get destroyed? That's what you need to be prepared for. The other thing for our clients is you always need to have adequate liquidity and you need to potentially deleverage. For retirees, what's really important is knowing that markets decline and they might take 3 years to recover on average. Let's have our spending money outside of our investment portfolio. Let's have a cash reserve in place already established so we don't need to be concerned about how we're going to pay the bills over the next 3 years. Don't rely on the portfolio so you don't need to sell low to pay your bills. Always have that retirement cash reserve in place and continue to use the dividends, interest to replenish that. So you don't need to be concerned what the market does today, next year, or the year after because you have a system in place to pay your bills. Now, same thing for all our wealth builders and wealth accumulators who are still continuing to run their businesses, grow, save, and invest. You need to have business reserves. You need to have personal reserves. Too many people are skating on thin ice in their business, or they're relying on their line of credit and they have no operating capital in their company. If there's a bad economy or something trips you up inside your business, how are you going to survive? You need to find a way to recover cash quickly to be prepared for an economic contraction or something that happens specifically to your business. It is critical. So this should be based on your personal expenses in both your business and your personal cash flow. How much is different for each person. Some companies might have stability, some people might have more stability in their income or multiple streams of income that might allow them to have less capital than the next person. But you need to have reserves in place. And then for other people, you need to think about deleveraging, getting out of debt, reducing the amount of debt that you have, or if you're investing in real estate and other assets, make sure your debt is long-term in nature. Make sure it's not going to be called in the next year if a recession shows up, that you can survive through that. And also set in place measures to have access to capital. Have access to a line of credit. Don't use it, but have access to it in the event that you need it during a difficult economic period, or to take advantage of opportunities that are presented by other dislocations and problems in the market. So very important, have adequate liquidity. Not enough people consider that. Think about Warren Buffett's stock portfolio and how much cash he's accumulated in Berkshire Hathaway to take advantage of the lower valuations in the future. He's not spending that money frivolously. He's being patient and prepared and having it so his insurance companies can survive the next financial calamity where many others will go out of business. Yep, sorry about that. Consider owning commodities. Not everyone was a fan of it. Certainly some people might be because of the valuations. It has an inverse correlation to stocks over periods of time. So if stocks perform poorly, commodities have done better during periods of difficult times in the stock market. So high inflation usually hurts both stocks and bonds, but it hasn't hurt commodities. And relative to stocks, it's one of the cheapest asset classes out there. So it may be worthy of some consideration. Everyone has a different perspective on it, just something to be considering and thinking about. Now, the last thing I think that's really important is you need to have a plan and you need to stick to it. I recently read that only 3% of people actually have a long-term written financial plan for their life. Your financial independent plan should account for market corrections. You should know that if a 20% decline happens in the stock market or a 40% decline happens in the stock market, what will that mean for your ability to be financially independent? All of our clients' plans know and are stress tested so that they can actually answer, if the market's down 25%, am I still okay? Well, your answer should be yes. If you don't have a plan, you don't have an answer to that question. So you need to make sure that your plan has the ability to help provide financial clarity under stress test scenarios. Because many times when people call concerned about the market, they're not really concerned about the market. They're concerned about their ability to live their life, fund their lifestyle. So make sure that we're asking the right questions and getting the right answers, and demand that you get a plan in place. Now, the other thing that you can do is, if you have an investment plan, then you should be thinking, how can I stick to it? You can be maintaining your asset allocation. So in good times, that's when you rebalance. It'll tell you, I have too much stock, I have too much real estate. Now is the time for me to sell because it's higher valued. If the market goes down, that's when you rebalance in difficult times and perhaps buy the things that are cheap. If somebody accumulates a lot of cash from dividends and interest, perhaps I'll be buying the cheap asset class that got beaten up during the previous decline. So stick to your plan. Don't abandon it. You got to have discipline and patience. And that's the key to planning. It takes the emotions out of the equation. So maintain your plan. If you don't have it, create it. Once you have it, stick to it and maintain it through good and bad times. It's the discipline. There's no perfect plan. There's only being disciplined about your plan and continuing to plan so you can be proactively prepared for changes that happen in life. And you want to avoid this. This is just the cycle of death when it comes to being an investor. Everyone starts to talk about Bitcoin. It's at 16,000, 17,000. Let me buy. I gotta buy. I love Bitcoin. And then goes down. They get scared and they sell. And then they keep repeating the cycle over and over and over again until they're broke. This is the cause of major underperformance when it comes to being an investor. So when it comes to performance, there's a thing. Being average isn't getting average. The average investor underperforms the market averages significantly. So this shows, there's a source called Dalbar. They do studies of investor performance inside 401k accounts. And this shows the growth of a $100,000 investment from 1996 to 2016 over the last 20 years. The average investor returned 4.8%. They turned their 100,000 into 254,000. The stock market itself returned 7.7% or $440,000. Why? Because the average investor does this. The market starts to go up, they get in. The market starts to go down, they sell. They constantly underperform, which costs them hundreds of thousands of dollars. So when you hear people say, oh, I can't trust the stock market, no, you can't trust yourself. You can't trust many of the people that are pretending to be advisors out there because they fall victim to the same thing. Emotions, no plan, no discipline in place. This is critical for your wealth building and critical for your success. So what can you take? What risk management measures can you be thinking about right now in addition to what we just talked about? Diversification. It's important to be diversified. You should have multiple streams of income. You should be diversifying amongst different asset classes. You should have different, investment processes. Maybe there's different parts of your portfolio that have different strategies. You might have a buy and hold stock portfolio. You might have a real estate portfolio. You might have business that generates income. So diversification means you have different things doing different things for you at different times. And in the traditional investment world, that's where you might want to consider favorably valued investments like emerging markets or international developed markets, or potentially even commodities because they're more favorably valued than the typical US stock portfolio. And why do I say that? The average asset allocation of financial advisors is heavily invested in US stocks and bonds. Over 70% of equity portfolios is in US stocks. US stocks represent less than half of the world's stock market capitalization. And we can also see the valuations are much higher, which means likely lower returns. So think outside the box. Don't do what everyone else is doing. Don't be the average investor. Do a lot better than that. And so maintaining a home bias is not ideal. And that reduces return and it increases risk. I'm not just saying that, it's the facts, it's stats. You need to understand that going forward. And you can also have different strategies. You don't just need to be buy and hold forever. You can be. It works for some people. You have to have the patience and discipline. But perhaps you could overlay that with a different strategy that follows trend. And it doesn't need to be all or none, but some of your portfolio. Have things that produce various returns under various conditions. Different return drivers in different market environments might be very powerful for you. You just need to have the discipline to stick with it. Also, real estate. Many of our clients have substantial holdings in real estate, and private real estate has very low correlation to the stock market, and it adds value. So you can see the correlation between real estate versus the Russell 3000, 0.23. So a 1 correlation means it performs pretty much exactly like the stock market. 0.23 means that is a very low correlation. And so what this has done is that if you add some private real estate to your portfolio, it actually reduces your volatility, it reduces risk, and it increases your return. So taking 20% of your stock allocation and putting it in real estate has proven to reduce risk and increase return. Now, this needs to work for you. You need to have the right amount of liquidity. You need to have the right financial situation to even do this, but it should be considered. And everyone's plan is different. It's not for everybody, but it could help reduce risk and increase return. Now, something that we've been talking about a lot with our clients is starting a business. Generate an additional income stream. Find a way to solve problems. Find a way to become an expert. If you generate $1,000 per month in additional income, that's essentially like having $300,000 in an investment portfolio. So how can you create a business that's attached to a small part of the economy that might not be driven by how the economy is performing? Think that through. Have a business that you love. Turn something from a hobby to a business. It could help significantly, especially during difficult times. Not enough people are thinking that way. You gotta be entrepreneurial, and you gotta find ways to generate income. And this can help alleviate any correction or any market decline because you now have another stream of income supporting yourself, where you don't need to be as concerned about the fluctuation on a day-to-day business. So that's the big thing that I've been thinking about, talking about with a lot of our clients and friends. Yes, the psychology of the market's changing. The volatility has picked up. We could be on the midst of a trend change that you need to be aware of. But there's things that you can do to position yourself to be prepared. Have liquidity. Have an actual plan. Know market history. And make sure that you are diversified smartly. Have additional asset classes. So I want you to be prepared. I know that it'll all work out for you. If you do have any questions, happy to chat, happy to talk more. Appreciate you listening, and successful investing. Talk to you soon.